Buying a home is supposed to be the responsible thing to do, the grown-up move. You stop throwing money away on rent and you start building something real, something yours. And in many cases, over a long enough timeline, that's true. Homeownership can build wealth. But the way most people get there, through a mortgage, is one of the least understood financial commitments they'll ever make. Most buyers focus on two numbers, the price of the home and the monthly payment. If those feel manageable, they sign. But a mortgage isn't just a loan. It's a 30-year financial structure with layers that quietly shape how much you actually pay, how fast you build equity, and how exposed you are if anything goes wrong. Understanding how it actually works doesn't make homeownership a bad idea. It makes you a far better positioned buyer. A mortgage is a secured loan. You borrow a large sum from a lender to purchase a property, and the property itself serves as collateral. If you start making payments, the lender has the legal right to take the property through a process called foreclosure. The exact legal process varies by country and jurisdiction, but the core principle is universal. The home is the guarantee. The loan comes with an interest rate, a term, usually 15 or 30 years in most markets, and a repayment schedule. Every month you make a payment. Part of that payment goes toward interest. Part goes toward reducing the principal, which is the actual amount you borrowed. What most buyers don't fully appreciate at signing is how those two parts are divided, especially in the early years. And that division is where the first and most significant financial mechanic of a mortgage lies. The repayment structure of a standard mortgage is called amortization. Your monthly payment stays the same throughout the loan, but what that payment is made up of changes significantly over time. In the early years of a mortgage, the vast majority of each payment goes toward interest. The portion reducing your actual loan balance, your principal, is small. As the loan matures, this gradually flips. By the final years, most of each payment is principal and very little is interest. This isn't a trick, it's mathematics. Interest is calculated on the outstanding balance, and in the early years, that balance is at its highest. But the practical consequence is significant and worth sitting with. If you take out a 30-year mortgage and sell the home or refinance after 7 or 8 years, which many people do, you've spent years making payments where the majority of each one went to the lender in interest. Your equity, the portion of the home you actually own, has grown much more slowly than your payment history might suggest. This is why the first decade of a long mortgage can feel like you're barely moving. Because in terms of principal reduction, you largely aren't. Here's the number most buyers never calculate at the time of purchase. Take a $300,000 mortgage at a fixed rate of 6% over 30 years. The monthly payment on principal and interest comes to roughly $1,800. Multiply that by 360 payments, and the total paid is around $648,000. The interest alone is approximately $348,000, more than the original loan. The numbers change with the rate and the term. A higher rate makes the total more expensive. A shorter term reduces the interest dramatically. A 15-year mortgage on the same loan at the same rate would have higher monthly payments but would save an enormous amount in total interest paid. Most people buying a home never see this figure laid out clearly. The monthly payment is front and center. The total cost over the life of the loan is buried in documentation that most buyers don't read carefully or don't fully process in the excitement of purchasing a home. The interest rate is not a small detail. It is one of the most consequential numbers in the transaction. A difference of 1 percentage point on a large loan over a long term can translate to tens of thousands of dollars in additional cost. This is why the rate you qualify for, and whether you shop for it rather than accepting the first offer, matters enormously. The mortgage payment is not the full cost of homeownership. There's a layer of additional costs that buyers often underestimate and sometimes don't account for at all until they're already in the property. The first is closing costs. When a mortgage completes, there are fees for the lender, for legal processing, for title insurance, for appraisals, for various administrative requirements. These vary significantly by market, but in many countries they can run to several percent of the purchase price. On a large transaction, that's a meaningful sum due at the time of closing, separate from the down payment. Then there's property tax, which in many markets is significant and increases over time. Homeowners insurance, which is typically required by the lender. Maintenance and repairs, which on a house tend to run higher than renters expect. Roofs, systems, appliances, structural issues don't appear on a schedule and don't wait for a convenient moment. And if the property is part of a managed development or condominium structure, there are often association fees on top of everything else. These costs don't make homeownership unwise, but they do mean that the monthly mortgage payment is the floor of what you're paying to own the home, not the ceiling. Buyers who plan only around the mortgage payment often find themselves financially stretched in ways they didn't anticipate. Mortgages come in different interest rate structures. Understanding the difference is important because the choice affects not just your payment amount, but your financial exposure over the life of the loan. A fixed rate mortgage locks in your interest rate for the entire term. Your payment stays the same. You know exactly what you're committed to. The trade-off is that if rates fall significantly after you borrow, you're stuck at the higher rate unless you refinance, which costs money and isn't always straightforward. A variable rate mortgage, sometimes called an adjustable rate, starts at a rate that can change over time based on a reference rate set by the market or the central bank. In some structures, the rate is fixed for an initial period and then adjusts. In others, it adjusts more regularly. Variable rates are often lower at the start, which makes them attractive. The risk is that if rates rise, your payment rises with them. In periods of stable or falling rates, variable mortgages can save money. In periods of rising rates, they can become significantly more expensive than expected, sometimes suddenly. This is not theoretical. Homeowners who took variable rate mortgages during periods of very low interest rates and then saw rates climb sharply experienced real payment increases that strained household budgets in ways they hadn't planned for. The rate environment at the time of borrowing is not a guarantee of the environment you'll be repaying in. As you pay down a mortgage, and as the property's value changes, you build equity. Equity is the difference between what the home is worth and what you still owe. It's real wealth, but it's illiquid. You can't spend it without either selling the home or borrowing against it. Borrowing against it is where things can get complicated. Refinancing allows you to replace your existing mortgage with a new one, often to access a lower rate or to extract equity as cash. Cash out refinancing, where you borrow more than you owe and take the difference, can seem like a sensible way to fund renovations, consolidate debt, or cover large expenses. And in specific circumstances, it can be. But it resets the clock. If you're 10 years into a 30-year mortgage and you refinance into a new 30-year loan, you've extended your debt by a decade. The equity you extracted comes at the cost of years of additional payments and additional interest. People who refinance repeatedly or who extract equity regularly can find themselves approaching retirement still carrying significant mortgage debt, not because they spent irresponsibly, but because the home felt like a resource they could tap. The equity in a home is real, but treating it as liquid savings tends to be more expensive than it appears. The down payment is the portion of the purchase price you pay upfront, before the mortgage begins. Its size affects the loan in several ways that compound over the life of the borrowing. A larger down payment means a smaller loan, which means less interest paid over time. It also typically means a better interest rate because the lender's risk is lower, and it affects whether you're required to pay mortgage insurance. In many markets, buyers who put down less than a certain threshold, often 20%, are required to carry private mortgage insurance or an equivalent product that protects the lender if you default. That insurance adds to your monthly cost without building any equity. The pressure to buy before saving a larger down payment is understandable. Property prices rise. Waiting feels like losing ground. But a small down payment means a larger loan, a higher rate in many cases, possible insurance costs, and a slower start on equity building. The urgency to enter the market can be real, but the financial cost of entering underprepared is also real. There's no universal right answer, but the down payment deserves as much attention as the property itself. A mortgage is not just a loan. It's a decades-long financial structure that shapes your cash flow, your flexibility, your wealth accumulation, and your exposure to risk in ways that the monthly payment figure doesn't capture. The home may well be worth it. For most people who stay in a property for a long time, pay consistently, and don't extract equity repeatedly, a mortgage is one of the more reliable paths to building net worth. But that outcome is the result of understanding and managing the instrument, not just signing it. The most common misunderstanding about mortgages isn't that people don't know they're borrowing money. It's that they underestimate how much they're actually paying for it, how slowly equity builds in the early years, and how many additional costs sit on top of the headline payment. Walk into a mortgage with the total cost in mind, not just the monthly number. Know the difference between your rate options and what they expose you to. Understand what closing costs will add. Plan for ownership costs beyond the payment. And be careful about treating the equity in your home as a casual resource to draw on. The house can work for you, but only if you understand what you agreed to before you got the keys.